Good morning. Welcome to Your Money Matters. I'm Angela Giroux, publisher of the Bauman Letter, and joining me is Clint Lee, research analyst, and Ted Bauman, editor of the Bauman Letter. Now, speaking of the Bauman Letter, we got a question on our last video asking if the Bauman Letter was free. No, it is not free. There's a lot of time, resources, and manpower that goes into it, but it is risk-free. So if you'd like to check it out, you can just click on the button on the top left of the screen, find out more, sign up, and you have a full year to decide if it's right for you or not, with absolutely no risk. Now, turning our attention toward the market today. Earnings results came in for big tech. We touched on it last week. It just came out yesterday as we record this on a Friday. We predicted that they would rock the markets. Rock the markets they did. Collectively, all four companies added something like $250 billion in market cap. And today we're seeing 3 out of the 4 are up, and quite dramatically. Clint, what does this tell us, and how do we position ourselves as investors?
Yeah, so I guess we've grown accustomed to some blowout earnings results from several of these names, and yeah, we had a large subset of the FANG stocks reporting earnings on the same day, all coming out after the close yesterday on Thursday, and for the most part, they did not disappoint. We'll show a table right here of each company: Amazon, Apple, Facebook, and Alphabet, Google's parent, and what the sales growth looked like year over year, the earnings growth from last year, and we also have what the stock reaction was too. Probably the numbers, but maybe not the biggest surprise, was Amazon. Amazon putting up 40% sales growth. Their earnings nearly doubled from the year ago period. They commented that their online grocery was up triple digits during the quarter. Their Amazon Web Services, their cloud segment, they're still seeing a lot of demand for that cloud infrastructure that they provide. That was up 29% in terms of revenues from the prior year. Apple also seeing a lot of benefits, seeing strong demand really across the board for their products. Everything from the cheaper iPhone model to their services segment, which includes things like their app store and their music services. We talked about how the whole stay-at-home trend, how that's benefiting areas like gaming. Well, they're seeing a lot of that same demand and within their app store, but also within Macs and iPads as well. With the remote work movement, and now we're being faced with the prospect of whether or not schools actually go back during the fall. I know around here there's a lot of uncertainty. Originally there was sort of this hybrid plan in place that you'd be there part of the time you wouldn't, but now it's looking like it might be all remote to start. So that's creating a lot of demand for just having laptops and things like iPads at home. And Apple CEO actually commented that supply constraints had capped sales of Macs and iPads during the quarter. So Apple seeing good results there. Probably the biggest surprise was with Facebook. There's a lot of uncertainty around Facebook just with some of the ad boycotts that were going on, but Facebook still able to put up about 11% revenue growth during the quarter, and kind of highlights that even with these big corporations, no single advertiser makes up a huge portion of their budgets. And even Ted sent something around earlier this morning highlighting that a lot of small businesses, because of constraints they face in opening, they're moving toward an online storefront, and Facebook's seeing some benefit there. Probably the biggest disappointment, the only disappointment in this group, was with Google. Their ad revenues contributed to the first decline in overall revenues in the company's history. When things start getting tough, ad revenues or ad budgets are usually the first thing to get cut, and their stock's reflecting that, down about 4% on the day. There's one more thing I want to show you, and it's framing up these companies' results in the context of the overall market. So the next chart I have here, this is earnings for overall S&P just before yesterday. So we have about 200 of the S&Ps reported that comprises this chart, so about 40% of the index. Even with Google's results being disappointing, earnings down 28%, they're still doing better than the overall S&P up to this point. S&P earnings in total trending down about 39%, and as you can see from this chart, every single sector is in the red for 2Q earnings.
And the markets are still up. Ted, what do you have to say about that?
Well, yeah, I mean, clearly this is This is a unique moment, I think, in stock market history for a number of reasons. Let me just flash up a chart quickly that shows that this is, in fact, the fastest 91-day rally in the NASDAQ in 20 years. Now, in a context like that, we know that these big companies are the ones that are driving it. There are a lot of other companies in the NASDAQ, little biotech companies and whatnot, and it's a pretty big chunk of the NASDAQ that's going up. And on the other hand, while these guys are up something like 34%, I think, for the year, the rest of the S&P 500 is down by 7% if you take them out. So yeah, I mean, this is basically a unique moment where we have become tilted dramatically towards these kinds of companies. The paradox is that the reason why these companies are doing so well is precisely because the economy is in such bad shape because of the virus. These are companies that are able to capitalize on the fact that people can't go out, that they need communications tools to be able to communicate with work and with each other, hence Amazon and Apple. Facebook, as Clint mentioned, has become kind of a mini storefront for a lot of companies. And of course, they do have certain payment systems that are now implementing, so they'll begin to get some revenue for that. So fundamentally, these companies have now become consumer staples, right? I mean, they are now essential to the US economy. They've basically taken 3 or 4 years worth of forward growth, and they've compressed it all into this particular period, this one quarter. And, you know, that's really quite amazing when you think about it. But I think that the one thing we've got to watch out for is that even these companies can't make money if people don't have money to spend. And so that takes us back to what happens with Congress now, this week especially. It's absolutely critical that these companies are able to, or that consumers are able to get some kind of relief. The second thing is that, and I think this is where a lot of people misunderstand my message and our message, even at these valuations, the rate of change going forward for these company stock prices cannot maintain this momentum. I mean, the PE ratios for some of these companies like Amazon are just extraordinarily high. And what that means is that, yes, it's great that they're doing this. It's great that they are benefiting from an otherwise bad situation. But if you want to position yourself to make good money when this COVID starts to disappear, you have to start looking at the companies that are beaten down, because the likelihood of rapid upward increases in their share prices is much higher than those for these companies. So that's just a word of caution. I think it's important to understand, we're not saying that these are bad investments. But the way to make money is to buy low and sell high, and these companies are at their highest. So fundamentally, I think that's the story. I think we're looking at a good situation for these companies, not so much for the U.S. economy as a whole. Clint, what do you think? I mean, we've talked about a rotation strategy going forward. Basically, right now, that seems like something that's far off, but does it have legs?
I think to the point you're making earlier, I mean, I think there's really two key considerations, especially with these tech companies, some of these companies that just reported yesterday, two key areas where they're seeing a big tailwind. One is just from the pandemic itself and what that means for remote work, what that means for companies like Amazon that are selling their goods online. The pandemic, I'm hoping, doesn't last forever. At some point, there's several vaccines in progress. At some point, even though it might seem far-fetched now, we will actually get back to normal. And so what does that mean for some of these temporary demand boosts that we're seeing, especially with companies like Amazon and Apple, that kind of pull forward in demand that you spoke to. The other thing is the economic stimulus. Personal spending in the second quarter was up something like 7% or just over 7%. I mean, that was right in the middle of a recession. But that speaks to the first round of stimulus that went through, the stimulus checks, the impact that had, the extra $600 in unemployment benefits, and the impact that had. I know Tim Cook, Apple CEO, on the call credited economic stimulus, across the world for helping boost their results, and Amazon's undoubtedly seeing the benefits of that as well. As that impact starts to fade, what does that mean for some of these demand trends for those companies going forward?
Right, absolutely. Now, I think, just if you look at the scenario here, what it suggests is that right now e-commerce is where you want to put your money. in the short term, because clearly anybody who is selling physical goods and services is at a premium, and Apple and Amazon have both benefited from that. Facebook to a certain extent indirectly, because of the companies that are trying to kind of do online marketing on the cheap using Facebook pages. But I think, you know, the big issue is around the broader economy, and that's why companies like Google have not done well, because Google, for all of its dominance in search, is heavily dependent on advertising. That's a market it cannot control. If advertisers pull back their money, there's nothing that Google has to substitute for that, and that's a big weakness for that company going forward. So I would expect to see Google's share price be under pressure for the next really couple of years, perhaps, if it cannot figure out a way to expand its revenues beyond advertising. More broadly, I would suggest there are a couple of takeaways. If you want to play this current trend, at least for the next 2 or 3 quarters, you could look at ETFs like iBuy, which is really focused on e-commerce, ONLN, which is focused more broadly on also e-commerce, and then CLOU, which is an ETF that focuses on cloud. Because one of the things we haven't mentioned is that Amazon, as well as Microsoft, and to a certain extent Google, are also benefiting big revenue increases in their cloud services divisions like Amazon Web Services. Because everybody wants to be online, these guys have the capacity to make it happen. So there's 3 takeaways. I think, you know, definitely play this in the short term. But remember that point. There's a limit to how much upside it remains for these companies. And paradoxically, when things start to get better, they won't be the big beneficiaries. It'll be all those so-called tired old world companies that some commenters like to say have no future. Their share prices are going to go back up, and that's where you're going to make money.
All right, great. Well, thank you so much. I can attest that I personally have been keeping Amazon in business, so I believe it.
We have to. Don't worry.
All right, thank you everyone for tuning in to Your Money Matters. We will see you next week.